Well, good afternoon, everybody. Welcome to the August 24th, 2021 edition of Bull Sessions. My name is Mark Robertson. I am generally joined here by Ken Kabula. He may be along any minute. He may have run into some travel delays, but we'll go ahead and get underway. Kim was also going to attempt to join us, but she's also not here. So again, we'll keep this very informal. We've been doing this for a little over a year now. If you have something that you would like us to chat about, I have a couple things that we're going to cover. Picking up where we left off a couple weeks ago with some of the bank screening stuff that we have done, but going to show some of the stuff that has happened at the website today, but going to save a lot of that for next week and probably the week following that as we begin to deploy some of the changes at the website. All right, just checking to see what's here. All right, so welcome. We're going to continue our return on assets screening of banks, doing a little cleanup on aisle 4, taking some of the more sporadic and erratic foreign and international banks out of the mix and centering in on the better part of the field. Big announcement. The Groundhog Jumbotron is in place. So the Groundhog leaderboard that we've been covering here every week since February is now at your fingertips. It'll be slightly different than the official score sheet that we'll look at here today, because the official score sheet updates continuously, including all corrections for splits and dividends, etc. So the one at your fingertips with dashboards, though, is pretty up to date and could be some good, clean fun for many of us. Might spend a little bit of time talking about some of the financial press that's out there today about the stock market going wild and the things that you might think about doing today. If you're not familiar with a YouTube presence by the name of Graham Stephan, that's him there making the face about some type of stock market catastrophe, which is about to go down. That's the typical kind of stuff that you see on the internet with respect to finances, and we'll talk a little bit about that. The punch bowl is there for that reason. He's basically getting the heebie-jeebies about Jerome Powell taking away the punch bowl and stopping with some of the stimulus stuff that's been in place for some time now. So we'll maybe kick that around a little bit also. Let me check and see if we've got any other hands or questions or topics or comments. Looks like we're good to go, so let's go ahead and do that. We'll start with our standard disclaimer. Again, no investment recommendation whatsoever is intended by the stuff that we do here today. This is all about an educational demonstration. What we are literally doing is taking a look at the lessons learned in what is now nearly 8 decades of the modern investment club movement, and attempting to share and learn, illustrate, and demonstrate some of the practices and techniques and analysis methods that many investment clubs use and many individual investors. You'll hear us talk about investment clubs. We consider this community to be one big investment club with the raw intent of sharing ideas and basically helping the person next to you become a better investor, and we all go along on that ride. That is our intent. Anything that we express here today is an opinion. We please do your own homework and conduct your own analysis of any company before you make an investment decision. That's important. Do your own homework. If we do own something that we're talking about, I'll try to remember to disclose that, as will both Ken and Kim. And once a month, we do have a program, a webcast called The Roundtable. I suspect that 90% of you are familiar with it. If you're not, it's on the final Tuesday of every month, generally 8:30 Eastern Time. We've been doing it since July 2010. What it amounts to is we'll sometimes coalesce around an educational theme, but more importantly, 3 or 4 or 5 of us every month will present an investment idea, basically showing the screening and discovery of an idea and the analysis that revolves around that particular stock selection And then we have an audience vote, an audience poll, and we have kept track of the internal rate of return on that tracking portfolio since July 2010, and that is running at approximately 19% per year. So we're quite happy with those results, and we hope that many members of the audience have benefited from some of those ideas that have flowed over the 11 years of the roundtable. So again, that is the final Tuesday of every month, 8:30 p.m. Eastern Time. If you'd like an email reminder about the event, please send an email to nkabula1@comcast.net. For today's session, if you'd like copies of the slides, they are always posted at Manifest Investing in the forum, or if you have a follow-up questions or a suggestion for a future bull session topic, please send an email to me, Mark R. at manifestinvesting.com. We'd greatly appreciate that. Let me do a quick check here for anybody else joining us. Looks like Ken may have been detained. All right. So we'll keep pressing on. Again, keep in mind that we can open up the microphone if anybody has any comments or questions as we go along. But again, we started these about, July of last year, and we've been pretty impressed by the topics which you guys have laid out for us and some of the stuff that we've explored over the year. And today we're going to actually continue that discussion about regional bank study candidates, along with perhaps a few thoughts in a Q&A session at the end with respect to some of the changes we're making at the website. So again, consider it open microphone. If you have something you'd like to specifically request or suggest, we'd be happy to hear it. We do have these in our bullpen queue for future discussion. Some of those we've touched on a little bit. We may expand on them in the near future. So again, if you have a topic or a subject that you'd like us to cover, please send me an email and we will do the best we can. All right, here's a quick graphic that we cover here often just to kind of set the tone. Again, the stock market has kind of plateaued out, and the ups and downs are kind of evening out here over the last several weeks. And we're basically looking at a situation where the stock market is pretty fully valued. I don't know whether it's significantly overvalued or not. All of the stock studies that we do would suggest that it's actually not as bad as it's ever been in terms of overvaluation. Stock prices are not, catastrophically high, but they're certainly not bargains around every corner either. So with a value line median appreciation projection, that's the red on the graphic here, or the dots on the up and down forecast chart. Again, you're talking about a return forecast, an aggregate return forecast on all of the stocks in the value line standard edition. And again, that has reached levels down less than 6%. It's currently sitting at about 7.8, or call it 8%. It averages somewhere between 11 and 12 over the years. And you can see that the buying opportunities presented by what happened a little over 10 years ago here on the left, and fairly recently, a year ago, with what happened in the markets. Here's that housing and financial markets correction of many years ago. Basically the cratering of stock prices. Again, the green bars represent the average stock price of the companies covered by value line. The cratering of those stock prices, along with still some fairly decent fundamentals, meant that for a while there were a couple back up the truck moments. And if you've been with Manifest Investing long enough, perhaps you remember we had a back up the truck party around Thanksgiving in 2008, and then again around March, the end of February in 2009. And those are pretty rewarding periods for investors who could grit their teeth and sink back in. Same thing happened a year ago with a really sudden drop, much more sudden than even what happened 10 years ago. Disappearing overnight, this peak in the return forecast. And again, I'm not so sure that all of us believed that it could recover so quickly and so mightily, but it did. and the stock prices have jumped back up to where we are again hearing things like all-time highs in the various indices. So it can happen fairly suddenly. Okay, let's see. Switched Kim back into the back room. She has been able to join us. At least I assume that she has been able to join us. We'll see when she gets herself unmuted.
Oh, I'm here.
Okay. Good afternoon. How are you?
I'm good. I have some caffeine in front of me. That'll help.
I'm on my third cup myself, so definitely in the mode of needing a vacation from a vacation. But man, I've got some work to do too. But anyhow,
it's hard to get out of that nice chilled mode.
Yeah, I'm really just grateful that you guys all took care of the stock market in my absence. Appear to have done
We try.
well, good work. Now the Groundhog, we haven't been doing so well. I mean, over the last couple of weeks, we have lost a little bit of ground here. What you're looking at, here's the leaderboard of our stock selection contest that runs from Groundhog Day to Groundhog Day. This is our 15th annual event. For those of you that may not be familiar, you're given $1 million on, they're actually Groundhog dollars, to invest in anywhere from 5 to 20 stocks back on February 2nd of the year, just to set the stage. And we track it as the year goes by. And you can see that the current leader has basically a return of approximately 50%. Terry did pass away here a few months ago, so this is a posthumous situation. And so we just nod in her direction and pray for her family. But a number of very familiar names at the top of the leaderboard. It is dominated by the ladies, and it's dominated by a number of investment clubs, including 3 of those top 5 clubs are actually Ken Kavula affiliates. So he's having a good year. He's having a good year, and his individual entries are right there at 21. But some wonderful names up at the top. I'm going to take a moment here to reflect on the long-term performance of Susan Michelik and her Bower City ladies. They're at number 11. They've got quite a track record, and they're zooming along pretty good. Anything jump off the page at you, Kim?
No, I just like seeing the Manifesting Roundtable, since you have been gracious enough to invite me on there, that we're up there in the top 20, because I'm probably in the bottom 20.
Well, I've joined you in the bottom 20, and it is nice to have that other entry as investing as a group, very investment club type mentality to give us something to celebrate. Because sometimes when our personal portfolios zig, our group portfolios can zag, and that can be a really nice diversification demonstration also. But I do notice that a few more of the celebrity entrants, like Warren Buffett at 19 and Abby at 25, there were more, and they have fallen by the wayside a little bit. Speaking of falling by the wayside, we're down a percentage point from 2 weeks ago, down to an average total return of 6%, and 36 of the 144 participants are beating the market. That 25% would be among the lowest number of market-beating entries that we've seen in 15 years. So let's hope that some people turn on the afterburners. And we do feature Kathy Wood out of respect, and we actually do respect her work and follow along as a wonderful source of ideas, that ARC Innovation Fund. But she's had a cold 6 months. The press has been on her. We might talk about that here in a few minutes also. But 134th out of 144. So better days ahead there, probably too. All right. In the moment you guys have been waiting for, as we do go through the site restoration and version update for the manifestinvesting.com website, we now are able to commit changes and make some revisions and enhancements and that type of thing. But this is one that everybody always wants, the Groundhog Scoreboard for the year. It updates daily, and you can see that that list here matches the previous list. Now, a little bit different because it's based on the closing price from yesterday or the day before, and the preceding page that was done mid-morning, so it would have reflected changes in stock pricing this morning. So don't try and match the two up, other than they will match up fairly well. We do have a moment for Sean Mace, who, thanks to his 8-for-1 stock split in General Electric and the fact that it wasn't corrected on our dashboard, he was at the top of the leaderboard for, I believe, 7 or 8 days, and along with Julie Werner, and they have been restored to their correct place in the standings. Not on this page.
Wasn't that a reverse stock split?
It was a reverse stock split, and what it did was inject about an extra $1 million of General Electric into their portfolios until everything was corrected out and the share count was split and the stock price was corrected, etc. So Sean enjoyed his days. I think he has a screen capture and may have laminated a plaque for himself along the way. It is, I'm constantly reminded that, when we look at these weekly results, that this is just a 1-year contest, and shouldn't get too wrapped up in the week by week standings. It's kind of fun to watch, kind of fun to dig into the portfolios. You can click on any one of these names and see what's actually making, what their selections were in their Groundhog portfolios for the year. The thing that I kind of take away, though, is the number of people on this list, from the Bill Thompsons to the Bauer Cities. The Bauer City Investment Club, by the way, has won the group championship a couple of times. And Lisa Robertson's always at the top. No relation. She's just a wonderful volunteer out in the Puget Sound, Seattle area. Joan Fosdick down in Florida. Again, these are names that are familiar to us within the volunteer educator community for the National Association of Investors and Better Investing. And of course, our buddy Nick D in New York is making a strong run at the top of the leaderboard. All right. I threw this slide in here. We show it from time to time just as a reminder that we have been doing this for 14 years, and the real emphasis is on the long-term performance. Once you're actually in the contest for 3 years, your relative return relative to the market over your period of participation makes you eligible for this list. So we keep track of these market beaters. There's quite a few on here. You basically are taking a look at some fairly solid success in investing. Sandy Castor, who's in the audience, actually has broken the scale on the left with her 3 years, checking in at a market-beating 27.8% up there at the top. And that wasn't even good enough to win last year's contest, but her 3-year performance now has her pretty high up in the standings. The Broad Assets down there in St. Louis just have a wonderful track record. They have won the group award at least twice, if not 3 times. You can see that Hugh, who's won the individual award, is up in there too. I did want to highlight this Bauer City because, sometimes I'll make a reference to the Bauer City. They're always lurking. They're always there. That's not a fluke. They're there a lot of the time. Note their standing in, the 13 or 14 years that they've been doing it. Consistent outperformance. And just a number of very familiar names, including all 4 of the Knights of the Round Table we talked about a few minutes ago. And here's Lisa down here. Some very familiar names, former champions. And we just like to point out, here's Bill Thompson, again, a regular attendee, regular contributor at Manifest, and just chugging along with participation that spans a number of years. And then, again, former champion, also in the audience right now, Ann Manning. Having a decent year this year, but she's actually taken home the top prize in years gone by, and Ann also serves occasionally at the round table. All right, switching gears. Kim, I don't think you were here for this a couple weeks ago. You weren't able to attend. we basically
I
had.
think I listened to it afterwards.
Oh, you
And
did?
yeah, how banks have been doing so well.
Yeah. I mean, we've had. I'm just stunned at how well some of the banks have done over the last year, especially in our best small company portfolio and in a number of places where companies like Western Alliance have really bolstered the results. And let me double check and make sure Ken has not been able to join us here. It looks like he
Oh,
has.
I've been with you for the last 2 or 3 minutes now. If you can make me an organizer, I'll do my normal job. I have no excuses except I was really late. So
Not a problem. Let me see.
yeah.
I'll switch you over. I was just going to brag about you in banks.
And hello, everybody.
Well, good afternoon, Ken. I know you've been traveling quite a bit too, and I've explained to the audience that I need a vacation from a vacation. Did you just get back this morning?
We got back last night, and I'm suffering from vacation lag here, trying to get myself motivated. So forgive me for being late. I'll be much better next week, I'm sure.
Not a problem. So we just pointed out that the Groundhog leaderboard is on the homepage and it's active, and you're number 20 or 21, so you can enjoy that at your leisure. But here's
I noticed the Mid-Michigan chapter up at number 4. That's a nice place for them to be finally. So
Yep. You and your clubs. Well, I think we might have to throw a big party somewhere with all of the affected parties here in the future. All right. So I thought what we would do is do a little bit of cleanup on what we had talked about a couple weeks ago. The basic core of the thinking is it is just one piece of the puzzle, but the incredible value of finding a bank that has a reliable and consistently superior return on assets. Some people call it return on average assets. I have done some comparisons of the numbers provided by Y charts and find that they are fairly comparable to the numbers that are kicked around in the better investing data. There can be some nuances, but as far as an order of magnitude or a representative comparison, I'm pretty comfortable with it. And the graphic that you're seeing basically shows the performance of the top 250, and what Ken has been suggesting over the last couple of years is that we basically hunt for companies that are better than what is shown on the screen. In other words, companies that are consistently up in this realm or perhaps even higher. And that is what was represented by First Financial and Western Alliance and a couple others. So a couple weeks ago, we dug in and took a look at the regional bank industry at Y charts. I was amazed to discover that there are 1,055 tickers. Now, some of them are redundant tickers with redundant classes and that sort of thing. But when you take those out and do a little bit of trimming, it's still quite a formidable list. And the question we kind of left with 2 weeks ago was a whole bunch of international banks from places like Azerbaijan and South Korea and Indonesia and Pakistan and Turkey and et cetera. We're showing up near the top of that list. You can actually go back and look at the list from a couple of weeks ago, and we kind of left with the question, should we regard them differently? And you can chime in here, but the thought that came to me as I was driving between here and northern Michigan was, you may recall that in value line, they separate out the Canadian banks. And then for the longest times, they separated out a wholly separate industry group for Midwestern banks. And the premise behind those separations was that they treated their business models differently. The way they conducted business on a daily basis was different than the coastal banks. I mean, I experienced that personally with my moves out to the West Coast in California. It was just different when it came to handling real estate and mortgages and all that kind of stuff. The banks in the Midwest were considered more conservative, higher percentage down payments on mortgages, that sort of thing. So the business models were different, so that when trying to do side-by-side comparisons, Value Line felt strongly enough about it that they actually did separate out the classes. So I think maybe what we saw with that list a couple weeks ago was some erratic comparisons of some of those international banks. That's my theory, Ken.
Well, I think there's a lot to be said for exactly what you're saying, Mark. I had the opportunity to enter into some conversations, and boy, I'm going to not come up with his name, but our friend from Value Line, who used to be in charge of the data and was seated on the NAIC board for a long while. Steve Sanborn, of course. And I had the opportunity to sit over an adult beverage with him a couple different times, and I remember talking about that difference in the industry classification, and he condensed it to just a few sentences by saying that the extreme conservatism, the extreme tendency of Midwestern banks to stick with a very simple business model and to make loans to people only on the basis of whether they could repay the loan, that had a lot to do with the fact that they felt they were operating in a different business model than perhaps a lot of the national banks and a lot of the bigger banks in regions that were faster growing or towards either coast. So I think we probably have the same kinds of reasons that there are good, solid reasons why these national banks. I think that last week we got a good reason that, in fact, people are paying for the privilege of putting their money in deposits in certain banks because of negative interest rates. And so I think that we get different business models, and therefore we get different returns on assets. And putting them in a different category, I think, is a good idea if we're going to look at gross averages like we're doing here.
Okay. And as we have pointed out, in this case, I ended up with whittling the list down to about 470, maybe 480 banks. And the median return on assets, that's after taking the international ones out, and one money center bank out. The median return on assets was about 1.2. That jives fairly well with Ross Meredith's range of number, I think. And
absolutely. He calls that, he said 1.25 is a good bank.
Okay.
0.85 he classified as an average bank, 1.25 as a good bank, and a superb bank up around 1.5. And he also made the point that we're looking at that to occur over a period of time. If it hits that number and then bounces off of it and back down again, that's not what we're looking for. We're looking for that kind of consistency over 2 or 3 or 4 years before you start to point to the bank and say, this bank knows what it's doing.
Yeah, and we actually can show that here. So here's a look at, and I know there's a lot on here. I just wanted to make the point that out of the 480, I basically whittled it down to the top 120. So those are 3 sets of 40. And as you just kind of scan through them, you'll see some tickers that you fully recognize. And notice that every single one of these is at 1.39 on the far lower right, all the way up to numbers that are north of 4%. And you'll see some tickers along the way that you already know. So these are the top 120 regional banks with the international banks suppressed. And some pretty good names on there. And again, that is a snapshot as 1 year. That is in most cases, it turns out to be the trailing 12-month return on assets for some of these companies. Now, some of them have a very limited. I think it was NASB at number 3. There are a few of those up near the top have a very limited operating history. So that's also, it probably fails to meet the criteria as expressed by Ross. So I took these 120 and I put them into a dashboard. Let me show you what the dashboard looks like first, then we'll come back one page. Here's the dashboard. It's actually a public dashboard, regional bank screen, so you can see all 120 of them. We cover 66 of the 120, so there's 54 that will be uncovered. We'll obviously cover many of those here over the next few weeks, but you're looking at companies from the perspective of the projected annual return, the return forecast on the right. So again, you could concentrate some of your shopping and head scratching on some of the companies that are on that right-hand side. I would probably have my attention drawn to some of the ones that have either blue coding for quality. That means they're in the top 20% of all companies, top quintile. So we regard them as excellent companies. And the green ones are still pretty good. They're in the top 2 quintiles, top 40% of all companies. But we do like to kind of constrain our shopping efforts, at least our original shopping efforts, to companies that are in that good or excellent range. And any names jump off of here, Ken? Some of your favorites?
Well, I own one of them, Mark. You go down about 2/3 of the way to IBCP, the Independent Bank of Michigan, a very, very small bank, but I own that one, and I'm very impressed with that par value. A year or so ago was in the mid-teens, so that means that the bank's been doing quite well recently, and its quality has been steadily improving, not dramatically, but just nice, steady improvement. There was also a lot of community interest a while ago about Bank of the Ozarks, OZK, about halfway down the list. And again, just a good quality rating, but some interest in that by quite a few different people. And then, of course, you've pointed to Axos, which Cy has brought up. That's the former Bank of the Internet, BOFI, and really, really high quality rating. No branches there. That's all online banking being done right there.
Mm-hmm.
I'm going to want to put some of these onto a spreadsheet and do some more digging, because I'm looking to add one more bank to one of the clubs that I belong to. So I'll be bringing some nice names. Yeah.
Here's another way to look at it. These are sorted by quality. So these are going to, exhibit strong characteristics, and we'll take a closer look here in a minute. But First Financial, which has been just wonderful for our best small companies, and in a couple of different portfolios, featured at the round table, and Ken has been infatuated with it for long enough to beat me in the horse race this year.
Well, I own First Financial. I own Western Alliance, those two, personally. And then clubs that I'm belonging to own First Financial, Axos, and Western Alliance. So they've treated the portfolios that they reside in, they've treated those portfolios really, really well over the last year and a half. At various times, Mark, I've owned Eagle. Oh, you just underlined it. I've owned Eagle and I've owned Glacier also. Both very high quality banks. Not much bad to be said for either one of them. For one reason or another, I've traded them out of my portfolios at various times, but I know those two, and I've had experience with owning them. Good, solid investments. I just think probably I traded them out for something that I thought would do better.
Mm-hmm. Well, the ones that jump off the page at me, Bank First here with the red arrow, the second red arrow on the page, just some pretty good numbers there. It could be might be one of them that you put in your list, Ken, for challenging away at. The other one that comes,
absolutely, yeah.
Ameris. This Ameris here, I don't know anything about them. The numbers are strong. I think I would be challenging this growth rate pretty strenuously. Put it through the arduous test of reality checking. But there's some pretty good ones here, sorted by, again, the quality of the companies. Ameris was on the previous chart also, I think. Yeah, up near the top with respect to projected annual return. Again, and I took a look at Merchants Bancorp a little bit. Very, well, you can justify that growth rate, but man, that's one that I'd want to dig in a little bit deeper to figure out what in the world are they doing. Are they really being assigned some high potential banks, or what is exactly going on there. One of the other points I wanted to make, people will ask, what are the asterisks for? The asterisk means when you see an asterisk by the company name in any one of our pages or dashboards, simply means that it's not covered in the Value Line Standard Edition, that it's an expanded or extended coverage company. So that just tells you that there's going to be a little bit less generally historical and projected information on the company. So again, underscoring the point here, Ken, here's a couple of the banks that show up, and including that first one there, Merchants Bank Corp, MBIN. That's the one that you see right here. And they are setting the world on fire. And I mean, just look at these general levels. There's
absolutely
certainly a story there to be dug into and comprehended. And then Ken had brought up last week this Northeast Bank, NBN, and this is more of a, to me, an illustration of, could this be a one-shot wonder? I don't know. I would need to know more about that story.
That's going to need a lot of research, because that's a number that I've never seen in a bank before, Mark. I've never seen one over 3, let alone over 4.
Yeah. So is there non-recurring stuff in there? I don't know. But what I find fascinating about this entire area, again, we talked a little bit about how some of our portfolios were just demonstrably bolstered by Western Alliance and First Financial. And I think this goes back probably between 40 and 50 years, to a guy that ran a regional bank fund for, I believe it was Fidelity. It was one of the Northeastern institutional companies. His name was DiCarlo, and he was just really good at isolating these. And I'm beginning to wonder if, with 20/20 hindsight, if probably shouldn't have paid a little bit more attention going back to that over the years. So again, here's your list of opportunity. You can go ahead and check in. If you find a hot one that's on that list, we'll actually go to it live. That's uncovered, and you take a look at it and do a preliminary stock study, and it looks very appealing. Let me know, and I'll turn on the afterburners to get it added to coverage at Manifest.
Well, the push on a simple business model bank is always the difference between what interest rate can you charge for a loan and what interest rate do you have to pay on a deposit. That's the difference in what makes a bank add assets to its pile of money that it owns, makes money, in other words. And with interest rates as low as they are, for some of these banks to performing as well as they are right now means that when interest rates move back to more normal levels, and I'm not willing to predict when that's going to happen, but it will happen at some point. And they've been historically just scraping bottom now for what, 6 years, 7 years, 8 years, maybe longer.
Mm-hmm.
And they're going to have to move back, and when they do move back, that's prime opportunity for some of these well-managed banks to just explode with profit.
Absolutely. I mean, here's First Financial. It shows how they've had quite a run. This is, when Ken was saying those words earlier, this is what's in his head. What you're looking for are companies that are able to stay at those elevated levels. First of all, these are all elevated, but they're staying at, in that 2% realm for a couple of years now. It's actually over 3 years. And then down here, I included this one. This is that Bank First, which kind of jumped off the page a little bit. It's an Oklahoma bank, and I suspect that the events of COVID combined with the energy situation, because it's an Oklahoma situation, probably explains a lot of that. So again, the study would have to include some assessment of, what can we recover back to longer term. And again, the numbers are not as flashy as the ones up here when you're seeing these type of numbers, but these are not bad. Again, keep in mind that average bank over the long term is, somewhere in there. So,
well, and that's the average of just a top group, also, right, Mark?
Mm-hmm.
That's the average of 250 out of over 1,000.
Yeah. So it's I mean, the
So
average bank probably is down underneath 1. You're right, Ken.
yeah, when Ross Meredith says that a good average number to look at is 0.85, he's not lying to us. He's just not lying to us at all.
Yep. All right. So, any other thoughts on that, Kim? Anything jump out at you with respect to banks, or?
Well, I do talk to Ross regularly because he's in my investment club.
Mm-hmm.
And I can say, as an international bank, he likes SAN.
That's Santander, right?
Yep.
Santander. Okay.
Yep.
And
I think the title of one of the largest banks in the world goes to Santander, doesn't it?
It does, and they have affiliates in different countries, and they just were buying up all of their Mexican partners' shares. They're going to take that up under the fold, and it's listed as an ADR here in the U.S. SAN.
okay.
My brother's mortgage was held two times ago by Santander. He's refinanced since, but he's in Boston area, and Santander has a pretty good presence in the Boston area.
Well, that almost sounds like a homework assignment. Again, that type of bank is not going to be covered by this list of 120 that we showed here today, because that would have been scrubbed out as a South American bank, I'm pretty sure.
No, it's actually Spanish, Mark.
Is it fully Spanish? Okay.
Yep.
So, it's Spanish, and the father was always an acquirer, and the daughter has now the head of the bank, and she's insisting how quality is the most important. It got really low in price, but it's almost doubled since it's low.
Well, I'll double down.
Next time you're in an investment club meeting, Kim, ask Ross to give you 4 or 5 regional bank names for us to take a look at. Okay.
Absolutely.
Well, I'm texting him as we speak.
Okay.
Okay.
Excellent. All right. All right, we'll keep it short today, but I just thought I would throw this out there just as a kind of a topic for discussion. I want to go back and read the book that Ken and others were talking about a few weeks ago, but this is, when you're looking at financial media on the internet, it kind of brings to mind Hugh's thoughts on financial porn that can be out there. I'm not accusing Steph and Graham of porn, but a lot of the stuff that is out there is so geared towards grabbing your attention and clickbait and all that kind of stuff. This guy's actually pretty good. If you're not familiar with Steph and Graham, I would encourage you to take a quick look, but it's kind of typical of what we're beginning to see an awful lot of from the talking heads and gurus as they begin to worry about the Fed puffing up of the market, however you want to talk about it, the fiscal stimulus that's been going on for some time, which has been arguably providing some support for the stock market. And what happens if they take it away? The meeting scheduled for Jackson Hole, by the way, was just switched from an in-person meeting to back to a Zoom meeting, which will be happening in a few weeks. We expect to hear some indications of changes in monetary policy, and will that disrupt the market? Who knows? And he recently just went through a quick review. Stephan just went through a review of some of these topics, which seem to be bothering people quite a bit. The September effect, the knowledge that September has historically been the worst month of the year for the stock market, to which I could just hear Ken thinking, "Who cares? Time to go shopping." that type of thing. We'll get to that, Ken.
I am, Mark. I am just so entertained sometimes by the sheer panic. It's like watching a weatherman who's dealing with a storm way out in the Atlantic somewhere, and you're asking yourself, are they hoping for it to turn and hit the U.S.? Some of these folks, the market goes down 1% from all-time highs, and everybody is on TV screaming doom and gloom, and the crepe is hanging so thick that you have to move it aside like Spanish moss to get through. I just can't figure out where they're all coming from. Sometimes we haven't had a regular kind of correction for 6 or 7 months now, and that's what's a little bit odd to me. I mean, normally corrections of 4, 5, 6, 7% happen 4 or 5 times a year, and we haven't seen one of those in quite a while. We're due for one of those, and it wouldn't especially convince me to do anything different than I'm doing right now.
Yeah, and that's the thing that kind of drives me crazy is, what are you worried about? What are you protecting yourself from? With the exception of if you're a person that again doesn't have any income coming in, and you really are preserving assets, and maybe you are in the mode of really being protective of those. I gave the example of things that got really toppy a few years ago, that I switched some of Dad's assets. He was in his 80s to cash equivalents, that sort of thing. But if you're a younger person, you really don't need to think about this stuff. Now, Stephen Graham is talking about the housing market taking a breather, maybe a little bit of a speed bump, quizzing as to whether or not there might be a stock market bubble. And the image I get when I hear this, and I'm not pandering to the gentleman from Atlanta, but Cy Lynch bought Home Depot stock very close to the IPO. And that's the chart that you're looking at there, the Home Depot stock price going back into the 1980s, for heaven's sake. And I mean, just look at that general tendency from left to right. And through some of the most arduous, we actually had a depression in home-related stuff, in this time frame. Home Depot was faced with a catastrophic challenge. This one wasn't much fun either after the turn of the century. But those two moments, this one lasted a little while. Stock price was flat for a little while. I absolutely guarantee you that Mr. Lynch was accumulating Home Depot as that stock price came down, and not regretting it for a minute. And I just find this chart to be extremely powerful. Was Home Depot overpriced right here? Maybe a little. In fact, I wrote a column about it at that point in time where I suggested switching from Home Depot to Lowe's. Maybe I'll dig up a copy of that and attach it to the show notes. But again, this notion of from left to right, lower to upper, up straight and parallel, however maybe we need a tapestry for this one, Ken. How do you just grit your teeth, especially if you're in an income earning, long-term time horizon, decent risk profile. This is the type of thing where, we're talking about buying stock back here for pennies, and it's not worth 300.
I think, Mark, if you've committed to the process that most of the audience for Bull Session has committed to, and that's long-term true investing. I mean, I know we have some folks that come to the webinar, and they would like us to move much more quickly and much more aggressively and spice it up just a little bit. And we're just not very spicy investors most of the time. We move in long time periods, and we're very, very patient. And back to that word again, we're extremely disciplined when it comes to investing. And that means you don't let a lot scare you. You don't let a lot panic you, and you use good common sense. I listened last week in between running out and doing wonderful things up in Traverse City. We happened to be back at the condo where we were staying, and I hit on the financial network for about an hour, and I listened to a terrible story about somebody that had taken their entire nest egg of $145,000 and plopped it into Bitcoin, only to have it stolen by somebody, and to find out it was irretrievable. And I'm thinking to myself, well, why in the world would you put all of your nest egg into something as untried as a cryptocurrency. You know, perhaps you were just a little bit greedy, and that 1.4 million that you lost, maybe you never really had it to deal with in the first place. So investing shouldn't be complicated. It should be something relatively simple, and it shouldn't be something that occupies your mind 24 hours a day, 7 days a week.
Absolutely. And I guess I'll just close. We had dinner guests the other night, again, sitting kind of around the campfire lakeside, and he's a very, very successful business person. And he wasn't talking explicitly about stocks, but he says that his dad actually said the words that the profits that you make on something, including in an investment, is done at the time that you buy it, not at the time that you sell it. And I think those are powerful words.
Well, that just reminds me of what Buffett says. Price is what you pay, value is what you get.
Yeah, I mean, so when we talk about, first go hunting for quality companies, excellent companies, and then wait for them to be on sale. I'm reminded of Hugh McManus and his shopping near 52-week lows. That's the reason he does that. Basically trying to buy something when it is truly a bargain. And that takes a lot of the stress out of investing if you do it properly and get adept at it. So again, the value that you make, the profits that you make are more a function of, what you pay when you buy it than when you sell.
Well, another thing, the three of us, truthfully, we're anomalies because we've done it enough. When the market has volatility, the three of us might be rubbing our hands together going, ooh, what's on sale?
Yeah, and I think a lot of the regulatory people, I mean, I've had personal conversations, not with some of the people that you're thinking of, Ken, but with other people who can't believe our attitude when it comes to, even as we look at this chart right in front of us, how could you possibly sit there during that lost decade, with your Home Depot shares? And I'd say they've done pretty well since 2010.
Well, and if Home Depot was all you owned, if all your money sat in Home Depot, maybe that wasn't the best investment. But I know for a fact that that's not all that Cy owns,
Right.
and he can afford to sit with a high quality stock like this and be patient while he looks for the EPAMs and the Cognizants and the, what else has Cy been really hot on, the Bank of the Internet, those stocks right now to help him keep his growth moving. So it takes all those things in a good, well-rounded portfolio, and we talk about how to put that stuff together. So it's again, this isn't magic, and it's not rocket science. It's just simply having some patience and having some discipline and learning the fact that a bad buy is 3 times as impacting on your portfolio than a bad sell.
Yep. All right. So what I've told the audience, especially in the green room, is that we're going to chart out some of the enhancements and stuff to talk about next week at the bull sessions. Probably focusing during the first run, because as soon as I get caught up a little bit on data, because I am neck deep in data, refreshing and that kind of stuff, going to start working on some of the screening stuff, and you'll see us adding things like relative strength index, and I'm giving some thought. Would love to hear your thoughts on it too, Ken, on adding a field for return on assets so that you could screen on banks and return on assets.
Yeah, especially, I mean, we don't have to have that screen. That screen means different things for different industries. But for banks, we know exactly what it means. And for that matter, for other asset-based companies, we know exactly what that means.
Yeah, so we'd have to do some training and tutoring to make sure that people use the tool properly. But I think it would have some value. So as with that as an example, I think that's what we'll do next week is we already changed the title from stock search to stock screen because we had a number of people that were having trouble between the general site search and the stock search. So we just changed it to stock screen on the home page. And I think we'll start there with the types of things that we want to be able to do and enhance and kind of take it from there. So tune in next week for that. You'll probably see some of that taking shape as the week goes by. Here's a reminder that we do archive all of these sessions, these bull sessions, at YouTube on the Manifest Investing channel. You can see that there are over 200 videos there, which also include our expected returns summaries, our roundtable sessions. That's the monthly webcast I mentioned a few minutes ago. And then as you see, kind of down the middle of the screen here, every once in a while we put on a multi-session educational conference. All 5 of those sessions are available there. And there have actually been 3 different examples of that over the last year. We actually referred to them as our COVID cancellation conferences in place of face-to-face meetings. So you can go back and go a little bit deeper on some of our emphasis on small companies. You can also go back and actually listen to the ideas. Somebody in the notes before the session pointed out that Charlene's Malibu Boats had a heck of a good day, either today or yesterday, up 5 or 8%. Charlene presented that during the May 2021 conference, so you can go back and check out those stock suggestions for further study. All right. And I think I'll just leave us with 2 of my favorite images from up north last week. One is the look from our actual tennis courts right next to the place, overlooking Burt Lake, Michigan. And then the one up at the top is my favorite thing about the whole week. Those are the shoes that belong to 3 grandsons. And that's got to be one of my favorite pictures in this world.
Mark, you're going to close it down, and then I have a couple of questions that we can maybe address.
All right. Thanks, everybody. We will go ahead and close it down. We'll see you next time. Thanks, everybody.